Welcome to the Deep Dive. We're all about cutting through the noise, getting straight to what matters. And today, we're tackling the latest financials from Force Motors Ltd, trying to figure out what their Q1 performance really means. So our mission here is pretty straightforward. Understand the unaudited standalone and consolidated results for the quarter ending June 30th, 2025. It's like getting a snapshot of the company's health right now.
Yeah, and we're working directly off their official filings, the one sent to the BSE and NSE on July 23rd. That includes the board meeting details, the financial statements themselves, and importantly, the auditor's review reports. It's the real deal.
Exactly. The source material is key here.
And why should you care? Well, because wading through financial reports can be, frankly, a bit much. We're going to boil it down, cut the jargon, and give you the essential takeaways so you can quickly get a handle on how Force Motors is doing and maybe, just maybe, what's coming next. Ready to jump in?
Let's do it. Okay, so first up, the board of directors at Force Motors had a meeting. This was back on July 23rd, 2025. Started mid-afternoon, wrapped up before 6 p.m. Pretty standard stuff.
And the main outcome.
The big things were approving those financial statements we mentioned, the standalone and consolidated ones for Q1 FY26, and also signing off on the limited review reports from their auditors.
Right. And it's worth remembering this isn't just housekeeping, this disclosure. It's mandated by SEBI regulations. It's all about transparency for investors. On the BSE, script code 50000033, and NSE, symbol ForceMot.
Absolutely, transparency is fundamental. So let's start where most people look first, the core business. We need to dig into those standalone results. They really show the fundamental health, wouldn't you say?
Definitely. Standalone is your starting point.
Okay, revenue. This is where it starts getting interesting. Revenue from operations for Q1 FY26. Let's see, 2,029,712 lakhs.
Wow.
Yeah, that's just over 2,297 cores. Big number. And compare that to the same quarter last year, Q1 FY25, which was 1,088,470 lakhs.
So a really significant jump year over year.
Exactly. A very healthy increase. What does that signal to you? Is it market share gains or just a strong market overall?
Well, it could be a mix of both, right? But growth like that, it definitely suggests a strong demand for their products, whether that's new models clicking with customers or just, favorable conditions in their main segments, commercial vehicles perhaps. It points to pretty effective execution on their part, meeting that demand. It's a strong market position indicator.
And that strong top line feeds right into profitability, which saw a real surge. Net profit, or PT, for Q1 FY26 hit 18,522 lakhs. That's up substantially from 11,959 lakhs in Q1 FY25.
Quite a leap.
It really is. And that flows straight through to the earnings per share, the EPS. Basic and diluted EPS climbed to 140.57 this quarter, up from 90.76 last year.
So not just selling more, but making significantly more profit on each sale, proportionally speaking.
Exactly. What does that suggest about how they're running the business day to day? Efficiency improvements?
Almost certainly. When profit growth outpaces revenue growth like that, it often points towards better cost control, maybe improved margins, could be managing raw material costs better, perhaps optimizing production, or even selling a richer mix of higher margin vehicles. It suggests good financial discipline alongside that expansion. It's a very positive sign.
Makes sense. Of course, growth isn't free. What about the cost side?
Right. You'd expect expenses to rise with revenue, and they did. Total expenses were 2,003,564 lakhs in Q1 FY26. That's up from about 1,071,409 lakhs last year.
And the main drivers there?
Primarily, the cost of materials consumed, that was around 1,070,663 lakhs. And employee benefits expense at 16,645 lakhs. So, direct costs associated with making and selling more stuff.
Okay. Now, there's a specific note in the report about exceptional items, net being zero this quarter. Why call that out?
Ah, good catch. That's actually quite important for context, because if you look back just one quarter to the one ending March 31st, 2025, they had a huge exceptional item, something like 39,457 lakhs.
Wow, okay.
Yeah. So these exceptional items, they're usually one-offs, not part of the regular business. Think asset sales, restructuring costs, things like that. The fact that there were none this quarter means the profit figure we're looking at, that 18,522 lakhs, is, let's say, cleaner. It reflects the core operational performance.
So comparing Q1 FY26 to Q4 FY25 directly would be misleading because of that big exceptional item in Q4.
Exactly. The year-over-year comparison, Q1 FY26 versus Q1 FY25, is more apples to apples for underlying performance because neither had significant exceptional items. That zero is significant because of its absence, you see.
Got it. That context is crucial. Okay, so that's the standalone picture pretty strong. But companies like Force Motors often have, other parts to their structure, subsidiaries, joint ventures.
Yeah.
How does the picture change when we look at the consolidated results?
Right. The consolidated view brings everything under one umbrella. And broadly speaking, the positive trend continues.
Okay.
Consolidated revenue from operations was 2,029,725 lakhs. Very close to the standalone number.
In profit.
Consolidated net profit was 17,636 lakhs. Again, similar ballpark to standalone, still showing strong growth.
So mostly aligned, but are there any sort of interesting details hiding in that consolidation?
Yes, actually. This is where we see the impact of their joint venture, which is called Force MTU Power Systems Private Limited.
Okay, Force MTU. What's the story there?
Well, while the main Force Motors business was clearly profitable, this specific joint venture actually reported a net loss for the quarter.
A loss. How much?
It contributed a loss of 895.96 lakhs to the consolidated results.
So the consolidated profit is slightly lower than standalone, partly because of this JV loss.
Precisely. It drags the overall group profit down a bit, but here's the kicker.
Go on.
Despite this loss from the JV, the auditors, Katan Pandit LLP, stated their overall conclusion on the consolidated financial statements was not modified.
Meaning they didn't flag it as a major issue.
Essentially, yes. It suggests that while the JV is currently loss-making, it's likely not seen as something that materially misrepresents the group's overall financial position. Maybe it's a strategic investment still in its early phases, or the loss was within expected limits. The auditors didn't see it as a red flag meeting a qualification in their report.
That's really interesting. So the consolidated view includes that nuance? Does it include anything else significant?
It also includes their wholly owned subsidiary, Tempo Finance West Private Limited, but the main differentiating factor this quarter seems to be that JV result.
Okay, so we have the standalone strength, the consolidated view with the JV nuance. What about the overall financial health check? The auditors gave their view.
They did. As mentioned, Kirtan Pandit LLP conducted what's called a limited review standard for quarterly results. And their report basically says that based on their review, nothing came to their attention that would make them believe the financial statements contain any material misstatement or haven't disclosed everything they should according to regulations.
So a clean opinion, effectively.
Pretty much, yes. For a limited review, that's the expected positive outcome. It provides assurance about the numbers.
Anything else from the reports confirming stability?
Yeah, a couple other points. They reiterate the company operates in a single segment, predominantly automotive. So all these numbers relate to that core business focus.
Right, no complex segment reporting needed.
Correct. And importantly, there is a confirmation regarding debt. It states no default, hence not applicable concerning payments on loans and debt securities.
Which is always good to see. Indicates they're meeting their financial obligations.
Definitely. Adds to the picture of financial stability alongside the profitability.
Okay, so let's try and synthesize this. What's the big takeaway for our listener from this deep dive into Force Motors Q1?
I think the main story is one of pretty robust health, strong year-over-year growth in both revenue and, crucially, profit in their core standalone business. That suggests good operational management and a strong market position right now.
And the consolidated view?
It largely mirrors that strength, but with that interesting detail about the Force MTU joint venture contributing a loss. However, crucially, that loss didn't seem to worry the auditors unduly regarding the overall group picture. And you've got confirmation of no defaults on debt.
So a picture of profitable expansion, generally well managed, even with some moving parts like the JV.
That summed it up pretty well, I'd say.
All right, so given this strong Q1, the single segment focus and that managed JV impact, it leaves us with a thought, doesn't it? What questions should we be asking about their strategy moving forward? How will they sustain this momentum, especially in what's always a dynamic market? What's the plan for the next quarter and beyond?
That's the key question, isn't it? Sustaining performance.
Exactly. Something for you to think about. And hopefully this encourages you to do your own deep dives, because digging into these reports can really uncover the stories behind the numbers.